Do you sometimes feel like talking to your mortgage broker sounds like blah, 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 blah? That's because it sometimes does. In today's video, we're going to discuss what some of the acronyms that we use, like LOI, COI, and different types of rates actually means. Stay tuned. Hey guys, Josh and Aaron back for another Finance Friday video, and in today's video we're actually going to break down some of the terms that you hear when listening to our videos. You probably might be thinking, what's a COI, what is a CMB, LOI, CMHC, what are all of these things and what do they actually mean? Well, we thought maybe we could break it down for you guys so you know what we're actually talking about. So in today's video we're going to break down some of the acronyms that we use and why you should know what they actually mean. First things first, we're going to get into what is the CMB, Canadian Mortgage Bond. So the Canadian Mortgage Bond was created in 2001, and this is the bond that is used to insure CMHC debt. Now, we've been talking to you guys about CMHC financing for quite some time. Probably wondering, how does it actually work? Well, what happens is a bond is purchased to insure a loan. So that essentially takes off the risk of a borrower defaulting on the loan, which makes it a great financial instrument and tool for hedge funds and banks to be able to purchase. So what happens is these bonds are purchased and sold at a certain rate, and this is allocated actually from the federal government to allow for additional financing and funding to spur investment in the Canadian economy. Now, you might have heard that allocation has increased. It most definitely has. The federal government has increased the allocation for the Canadian mortgage bond significantly over the last 24 months to spur new types of innovation and development into the multifamily space.
Second term we're going to talk about is the overnight lending rate. So the overnight lending rate actually depicts the rate that major financial institutions lend to each other at the end of the day. So whenever they're trying to fill it out their bank balances and they're borrowing from one institution to another, this is the rate that the banks are actually borrowing the money from each other. Now, how does this impact you guys as investors and consumers? Well, your overnight lending rate is going to impact any sort of variable rate that you may have. This is going to impact your credit cards, your secured lines of credits, your unsecured lines of credits, your variable type mortgages. All of these are going to be based off of your overnight lending rate. So as the overnight lending rate increases and decreases, that's going to impact the rate that you're paying back on these unsecured and secured lines of credits, anything that's kind of essentially revolving, and including your variable mortgages.
Yeah, and you might have heard, like, is the rate going up? Is the rate going down? When they're talking about the rate, they're talking about the overnight lending rate, and that is what the Bank of Canada decides on, which inevitably moves your prime rate, which moves all of your debt that you guys actually feel. So the people who have those variable rate mortgages, this is what they're talking about when they're talking about raising the rate. We're going to get into prime rate. What is prime rate and how does it work? Well, prime rate directly is impacted by the overnight lending rate. So your prime rate is the rate in which a bank will lend you money. So you might have taken a variable mortgage and it was prime minus or prime plus. Now, this is going to change depending on the actual piece of debt that you're taking on. So for example, if you're taking on a variable rate mortgage, you most likely have a prime minus mortgage. Now, your deduction from prime is dictated by the current lending environment that you're in. You might have a low deduction in prime in today's market, but 2 or 3 years ago, you might have had a very large deduction in prime. It really depends on what kind of market you're in and what that looks like. So your prime rate is affected by the overnight lending rate, and that is the rate that you guys should watch for when you're looking to either determine whether or not your payment is going to go up or it's going to go down. If you're looking to take on variable rate, which has prime rate associated to it, usually what happens is for unsecured debt, such as personal lines of credit, you would have a higher association to the prime rate, essentially meaning that you'd probably be prime plus, let's say 1 or 2% if you had an unsecured line of credit. But if you were to take on a variable rate mortgage, which is a secured mortgage, you probably have an association with a prime minus association to it, like prime minus 1 or prime minus 0.5 for a home equity line of credit. So the association to either a secured or unsecured asset is going to determine whether or not you have a addition to prime or a subtraction from prime rate.
And then continuing off that, obviously we're going to take a look at the difference between what a variable rate and a fixed rate mortgage is. So the variable rate mortgage, again, based off of the prime rate, there's actually two subsections of a variable rate. There's your ARM, or an adjustable rate mortgage, which actually reflects in your mortgage payments, increasing and decreasing with the movement of prime. So if prime were to go up, your actual monthly payment would increase, and if prime decreases, your monthly payment would decrease. Now, the other type of variable rate is your more traditional type variable rate, or a static rate, static fixed rate type variable rate, where your actual monthly payment doesn't necessarily change based off the movement of prime, but the amount of principal and interest you pay in that payment is going to change based off of the way prime moves up and down. So one of the things that we just saw over the last couple of years with the prime and overnight lending rate shooting up was a lot of these fixed static rate variables hit something that was called a trigger rate, meaning that your monthly payment actually increased, or the prime rate increased to such an extent that you were no longer paying enough principal to be able to pay down your mortgage within that amortization. And one of the issues here was that we were seeing amortizations extended into the 50s, 60s, 70s with some of these static variable rates. So again, when you're taking a look at this, and one of the big things that you have to do is talk to your lender and make sure that you understand all the intricacies with this variable rate mortgage and what are the outcomes based on the environment. Fixed rate mortgage is obviously based off of the bonds. Bonds tend to kind of move in prediction of what's going to happen with Bank of Canada and some of that overnight lending rates. If you get into a fixed rate mortgage, your rate is fixed, like it says, for that term. So if you get a 1-year term, it's going to be fixed for the 1 year. If you get a 5-year term, it's going to be fixed for that 5 years. The fixed rates obviously carry some sort of different payment penalty. If you're going to exit your fixed rate, it's going to be either the greater of your interest rate differential or 3 months interest, again, depending on which is larger. When it comes down to actually picking this type of mortgage and which one you're going to go with, it comes down to the benefits that you want from your mortgage. If you want flexibility of exit, well, then your variable mortgage is going to be, probably your better option. If you're looking for something secured and locked in and you want to know what your payments and your cash flow is going to be for a certain period of time, well, then your fixed rate mortgage is going to be the option that's going to give you that security and guaranteed cash flow.
All right, let's take a look at COI. COI is a term for Certificate of Insurance. When you submit a file to CMHC, CMHC will go through the process. They will review the documentation. They will verify you meet all the specific requirements, and then they will issue the Certificate of Insurance. The Certificate of Insurance is a certificate that provides a lender with the terms, the maximum financing terms available for the loan that is being presented to them and what they'd be willing to insure the property for. This is specifically made for commercial financing options. What would happen is we as direct correspondents would submit the file to CMHC, get the COI, and then a lender would then issue a commitment based off the terms outlined in their Certificate of Insurance. Most of the time, you would not see the Certificate of Insurance. It's something that's more of an internal process with your broker and the financial institution that is facilitating your loan. But the Certificate of Insurance is a pivotal part in trying to get your CMHC financing options available.
Yeah, when we're waiting for CMHC to get back to us, and it's in the underwriter, that's specifically what we're waiting for. We're not necessarily waiting for a commitment at that point. We're waiting for the Certificate of Insurance from the CMHC so we can go get you that commitment. And then keeping on this topic, one of the other terms you're going to hear is an LOI, or a letter of intent, or a discussion paper, or a term sheet. These are essentially all interchangeable terms. They all mean the same thing. It's an initial intent of interest, a letter of offering from the lender that states, based off of the details that we've given them, they are interested in giving you a mortgage based on the outstanding conditions that would be needed to follow through. So those conditions are going to be, satisfactory appraisal, maybe an environmental, financial statements from the building, financial statements from the borrower, proof of funds, proof of net worth. Again, it's going to be just that intent of interest and the intent to offer. If we can't follow through on any of those conditions, obviously we're not going to get the commitment letter that's going to be issued later on. So when you're making your decisions on financing and going firm, you have to understand that on the commercial side, which is where we tend to see these LOIs offered more often, probably not your best option to be going firm at. We do try to recommend our borrowers to extend that condition of financing, 4 or 5 weeks out, so we can actually get the actual commitment letter, which is the firm offering of financing from the lender, because those LOIs can change based upon documents that get submitted into credit in the due process on the lender's behalf.
Yeah, we understand that these terms can be confusing, and sometimes that listening to us talk about mortgages can kind of sound like a bowl of alphabet soup. So what we want to do is create this video today to make sure that you guys kind of understand what we're talking about. If you do have any questions about what we're talking about, some of the terms we spoke about today, or if you have any questions about some documents that you've read or seen, feel free to give Aaron and I a call. We really appreciate you reaching out to us. If you did like this video, please hit the subscribe button, hit the like button. It allows us to make more content like this for you, to keep you guys informed. We really appreciate you taking the time to watch the video today. We'll see you next time.